So I've reached part 3 in this series where we discuss mortgages and life insurance. Tom has a mortgage of $1.5 million and we already discussed that he has life insurance for $1.5 million, right? After 20 years of paying the bank, the amount that Tom owes the bank is going to decrease. So although you would have borrowed $1.5 million at the start, of course this amount will keep decreasing. So let's say after 20 years he's owing the bank $500,000. Let's say Tom property goes up in value. Say you would have purchased it at $1.5 million. After 20 years, it's gone up to $2 million. I'm keeping it simple. Of course, it could go up by more. If we take $2 million, the current value of the property after 20 years, and minus it from what he's owing the bank, which is $500,000, Tom has $1.5 million in what we call equity. Persons can use equity on their property and you can use it as a form of collateral, or you can use it as to get an equity loan, or you can use it as a line of credit. Why would you want to do that? It could have many reasons. Some people may use it for medical expenses. Some persons may use it to invest. It really depends, right? Key point once again. How does Tom get this equity? The bank will only give Tom this equity loan or this equity line of credit based on his ability to repay. It doesn't matter if it is he has $3 million in equity, he still has to show his ability to repay. Why is that important? Because if Tom was to get a demotion, if Tom was to get a drop in salary, if Tom was to lose his job, he cannot go to the bank just because he has equity on his property and the bank gave him this equity. But remember this $1.5 million in life insurance that he took when he now took out the mortgage? Here's why it's important to know on how to structure your life insurance to a mortgage and not just do any type of life insurance. This $1.5 million, depending on this life insurance structured, let's say he has been paying that for 20 years because he started it when he did his mortgage. This now becomes liquid property. As Tom was paying his life insurance was building value. Now, this could only be done with an endowment or whole life insurance. Why? Because these are the two types of policies that offer guarantee returns. So, let's say Tom life insurance is $1.5 million and he started at the same time he did his mortgage, and this life insurance now has a cash value of $500,000. Tom doesn't have to prove his ability to repay. All Tom needs to get this $500,000 is work with 2 forms of ID. It differs from the bank. He doesn't have to show his ability to repay to access his cash value from his life insurance. And because Tom structured his life insurance to his mortgage and did it via endowment or whole life policy, he has a guarantee funds that he can access to if the bank is unwilling to give him the equity on his loan. That's just one example. Let's say Tom was able to get the $500,000 from the bank and his salary didn't drop, he can still come and take $500,000 from his life insurance policy as well, and that is easily $1 million. So having the type of life insurance in terms of how you do your mortgage and how it's tied to your mortgage is also important if you're thinking in the long term. Stay tuned for part 4.